Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm Benny Victory. We're going to pick up where we left off in the last video, and that has to do with the idea of the reverse mortgages cost too much, and this idea that the cost is prohibitive, and as a result the senior doesn't pursue looking at to the features and the benefits of the reverse mortgage. And the video series that I'm doing, and the reason I'm breaking it down into little subparts, is because I want to have shorter videos to have more of an impact, and also to have each topic have a little bit better coverage, so that I don't do an hour-long video, because I know none of us have the attention span that keeps the subject that interesting, other than to me, because I could talk about this for 3 hours and I'll still be excited about it. But for the other poor tortured souls that have to watch this, I have to be mindful that I want to make it shorter. So what we started, and what behind me should be familiar to you if you saw the first video that I did dealing with objections, we said it's too expensive and it's too costly. And I broke it down in terms of saying, if you really want to determine the cost, you also have to have a proper perspective and a narrative around the value that you get along with that cost. And I made the example that there's a reason that a Rolls-Royce costs $400,000 and a Hyundai costs $25,000. And no offense to anybody who's a Hyundai driver, they're fine cars, but you have to understand that the expectation that you have when you pay for a car that's $400,000 is a different expectation than you pay $25,000. And that's just not for cars, but that's for everything else in value in life. When you pay more, you expect more. So given that the biggest line item in the reverse mortgage is the mortgage insurance premium, we need to determine what that is. And I broke it down in terms of saying, what is it? What does it include? What does it cover? And who does it protect? The borrower, the borrower's estate, the lender, and who gets paid by it, and why is it needed? So today I want to cover these four and lay the groundwork for what the mortgage insurance premium is and its relationship to these things. Because if you understand this, then we could kind of cover the rest of them in the next video. And this was the groundwork that I laid out on the previous video. So in terms of continuity, if you're watching this video, for it to make full sense, because I went and I discussed the features and benefits of the reverse mortgage as it relates to the protections that you get by having the reverse mortgage and why you want to benefit from it, I would watch that video first so that it helps you in terms of continuity. So we're going to flip this around, and now we're going to get into the discussion of what mortgage insurance is and why you need to have mortgage insurance protection. And in a couple of these videos, I've broken down the whole idea that the most similar analogy that I can make for the senior who's contemplating possibly getting a reverse mortgage, the mortgage insurance premium is the backbone, is the very reason that the reverse mortgage is even available. Because if you think about it, the idea that you can live in this house, your house, for the next 10, 15, 20 years, and that neither you or your spouse has to make a mandatory monthly mortgage mandatory monthly mortgage payment, is pretty incredible. And I know that the reverse mortgage has a bad reputation, but the reputation comes as a byproduct of certain people not understanding it, certain old rules that are no longer in place. And if you can disregard those old things that are no longer valid with reverse mortgages, then you'll be in a position to really appreciate and benefit from the reverse mortgage. And the reason I say it's incredible, and the reason I say that the mortgage insurance premium is the backbone of the reverse mortgage, and the reason it can exist is because you're talking about an extended period of time where no monthly mortgage payment is required. And the importance of that factor is that obviously the lender is expecting to get the money at some point. And that combination of getting the money for the lender at some point has to do with the amount of equity that you have built, which is what I refer to as housing wealth appreciation. The combination of the interest rate of the program when we're doing the initial loan calculation to determine what percentage of the home value you're getting, and the age of the youngest of the two borrowers, or the age of the youngest borrower. And these are all videos that I've kind of done in subparts that you could go look at in the playlist that has to do with how we calculate age for determining the reverse mortgage loan amount, and the features and benefits of the reverse mortgage, why there is no monthly mortgage payment required with a reverse mortgage. So those are all little pieces that are now in existence in the playlist that you could go back to. But as it relates to the overall concept, the importance of the mortgage insurance premium, the MIP as I will refer to it, is that the MIP is the reason that the reverse mortgage is even in existence. And the best way I could make that analogy to you, and one that I referred to previously, has to do with your relationship with you, the lender, and when you got the note, the promissory note that you signed on the house, you agreed to a couple of promises. First and foremost, you agreed to pay timely mortgage payments. Then you agree to maintain the property. You agree to pay property taxes on time. But you also agree to have homeowners insurance in place. And the reason you agreed to that is because of the relationship you entered with the bank. You understood that the bank is looking at the house as a collateral. And that collateral gives the bank a security interest in terms of knowing that should something happen to the house in case of a fire or a disaster or some sort of a situation where the house is destroyed, then the lender's original money that was lent to you is protected, and that the insurance company will reimburse the lender. And that's the nature of insurance. Insurance is in place to reimburse you. You pay a premium and you enter into a contractual obligation, and the insurance company agrees to cover you for a certain coverage period, for certain coverage protection, and you agree to make monthly payments. Well, when we're talking about this analogy that I'm making so that it's very comfortable for you, so when we go to the MIP conversation, in the traditional relationship between you and the lender, you get the homeowner's insurance to protect yourself in case of what? Well, you get it as a borrower and as a homeowner for you to be protected from fire, theft, damage, or personal injury. In other words, should any of these events happen, your insurance company will step in and indemnify you. Well, the bank, the lender, is also protected. And how are they protected? Well, the lender is protected against fire loss and through damage. So when you get your homeowner's insurance, what do? Well, you go to an insurance company, like, for example, State Farm, and you say, I want to get a homeowner's insurance policy because I'm in a relationship, a contractual obligation where I have to maintain insurance protection. And they'll say, fine, your premium is going to be $1,500 a year and we'll cover you for these things. And now you have insurance protection in place. Well, what you already know is that these are the things that are covered: the fire, the theft, the damage, the personal injury lawsuit. But you inherently understand, and you know just by virtue of having had homeowners insurance all these years, that what is not covered through this form of insurance is what? Property value or equity loss because of home value depreciation and market loss. And this is an example that I can go back to and you remember, because in 2008, 2009, in housing crisis that we encountered, there were people that had mortgages, traditional mortgages, not even reverse mortgages, traditional mortgages where they had to pay monthly mortgage payments. And they were making these payments, but property values dropped significantly. And because of the property value depreciation, what happened? Property values actually went below how much the existing mortgages were at the outstanding balance. And what did these people do? A lot of them just walked away from the property because they said, look, I have a $800,000 mortgage, but my house is worth $600,000. The house that I bought for $1.1 million is now worth less at $600,000 than how much I owe on the mortgage, which is $900,000. I'm upside down, I'm underwater. And they walked away and they got into a short sale, which is they sold the property for less than what the value of the loan was. Now, in those situations where the short sale happened, their legal obligation to the lender didn't end because of the short sale, because the lender had an interest on the property, had a lien on the property, and through the promissory note that they had signed with the lender. And this is another set of videos that I have in the playlist where I establish and I go into big detail about the conversation around your relationship with the lender, with the house being as a collateral, and I liken it to having a triangle in place. And I would encourage you to watch that, because that's the nexus, that's the founding principle of why a bank doesn't need to be on title in order to be able to pursue a foreclosure. And those videos establish that. But for the purposes of this video, continuing on the concept that a lender who goes through a short sale still can do what legally? Can pursue a deficiency judgment against the homeowner. And a deficiency judgment is when the lender says to the homeowner, we sold the property for $600,000, but you still have a balance left to us. So even though we're short, we can come after you and get the deficiency because we have a judgment from the court and we can pursue you for the difference. Okay. And the reason I'm laying it out on the side of the homeowners aspect before I go into the MIP conversation is because I want to distinguish between the two forms of insurance that we're talking about. You automatically understand that if your house, God forbid, is burned or broken into or damaged through a flood or something like that, or there's a personal injury, your homeowner's protection through State Farm kicks in. It protects you and it protects the lender. But your homeowner's insurance policy through State Farm doesn't protect you if in the next 10 to 15 years there is another perfect storm of what happened in 2008, 2009, up to 2012. Okay, and that has to do with the market loss of property value depreciation. And should that happen while you're in retirement, should that happen while you're having to make this mandatory monthly obligation, well, it's going to have a significant impact to your retirement. And the reason is because, first of all, you're obligated to make monthly mortgage payments. Second of all, you lose all of your home equity potentially, or a significant amount of your home equity. And if you want to sell the property, you're not going to be able to, because a lot of these people said, look, I'm making a payment on a house that I can't afford and I don't even have enough equity. And that was the whole premise around the short sale and the foreclosure. Now, what does that have to do with the reverse mortgage and the MIP? Well, mortgage insurance premium is insurance protection. And to go and answer the questions that we talked about on the other side of it, what we want to cover is that it's the FHA. It's the FHA. It's the FHA that requires the existence of the mortgage insurance to be in place. Now, the lender, when they get the mortgage insurance, they don't go to State Farm and say, we want to get Mr. and Mrs. Jones mortgage insurance protection so that should a scenario happen when the property is upside down, that we can come to you and get this coverage. What do? The lender, through FHA, goes to the Mutual Mortgage Insurance Fund. And it's similar concepts. That's why I rolled this out first and then talking about the second. So the Mutual Mortgage Insurance Fund is an insurance fund, and it's insurance that's able to be protecting both the lender and the senior. And the way it works is that the insurance, that big ticket item that everybody complains about and is the biggest number in terms of looking at what the disclosures are and the cost of it, becomes an item where it's insurance just like this was insurance. And the way this insurance works is that it doesn't deal with fire loss or damage or anything like that, because that's this side. This insurance protects the lender as well as the senior's estate, and the senior's heir. And what does it protect against? Well, it protects against exactly everything we talked about here, which has to do with depreciation of property values and loan amounts being higher than what the property values are. So that given the scenario that you understand that your retirement and you staying in this house could be 10 to 15 or 20 years, and the fact that we don't have any control over property value appreciation or depreciation, we understand that should a situation happen where in a reverse mortgage, when we're not required to make the mandatory monthly mortgage payments and property values come down, if the senior passes away, if they have to sell the house to move out, if any of those events take place, and at that time, which is beyond our control and beyond what we can see at this point, property values are less than what the current mortgage balance is, this mortgage insurance premium will step in and will reimburse the lender, the bank, so that the lender and the bank can't go after the senior, who's the borrower, or their estate if after their passing, or their heirs, against what? Against a short sale or a deficiency judgment. So it's a form of insurance, and unlike this insurance, the homeowner's insurance, where you have to pay yearly out of pocket, and I made the example that if you've owned your home for 20, 30, 40 years, you've been paying this money yearly out of your pocket, the purchase of this mortgage insurance premium is not made out of pocket. It's paid and a fee that is added on to the loan amount, and it typically comes as a result of your house value wealth or home value appreciation. Okay, and one of the things I talked about is that to determine the formula, we're going to do the formula later on, but I just want to play out all the aspects to it, the benefits of it, the features of it, and what it is. But basically, that's what it is. And the reason I say that the mortgage insurance is the backbone of having a reverse mortgage is the lender is guaranteed that should a situation happen where the senior sells the house and there's not enough equity in the home because of significant property values coming down and the senior having lived in the house for a significant period of time, in case of those kind of relationships, the lender can be reimbursed through this mutual mortgage insurance fund, which is in essence the mortgage insurance protection. Now, the reason we have this is we want to protect the senior against what this was. And to have that protection, we call that it's a non-recourse loan. In other words, a reverse mortgage is a non-recourse loan because the lender, who's the bank, can't come after the senior for its legal course, which is what this is. This is the short sale deficiency, because this loan allows the lender to come after, but because a reverse mortgage is a non-recourse loan, the lender gets reimbursed through the mortgage insurance fund. Now, as a result of this, the senior doesn't have to worry about if they're upside down to have a short sale, because the senior can simply stay in the house for as long as they want. Their continued obligation is simply to pay property taxes, homeowners insurance, and maintaining the property. Not having to make the monthly mortgage payment obviously makes everything else easier. But the fundamental difference and the biggest protection that you get here with this form of insurance that you don't get here is the fact that the reverse mortgage allows you to not make monthly payments, that you, your heirs, your estate are protected against a short sale, against the lender coming up. And that's the one big feature that I keep stressing with the reverse mortgage, is simply the fact that you're not obligated to make that monthly payment. And through that ability to not make the monthly mortgage payment, that gives you a tremendous amount of flexibility and freedom. And that extends your reserves, that extends your ability to be able to pivot and use that money for other expenses, but it also, most of all, gives you the non-recourse legal protection. So the next video that we're going to do, we're going to pick up where the rest of the questions are that have to do with what other protections the mortgage insurance premium allows you. And then I'll show you the different aspects and how they play into each other. Thank you for your time. Thank you for being my client. God bless you, and see you on the next video.